Hello, Ken. Thank you for joining us.
Thank you.
How are hedge funds doing so far in June?
Yeah, June's been a good month for the hedge fund industry overall. Overall, we've seen financial market volatility continue to decline, just like we did in the month of May. So, really, continuation of a lot of those trends. Equities are really kind of trading in a narrow range and really pretty much unchanged for the so far for the month. And really, it's almost the same for the bond market as well. You've seen yields trade in a very narrow range. People are really sensitive to inflation and expectations of what's going to happen with Federal Reserve rate cuts. But thus far, in the first 2 weeks of June, you really have ended up in almost the same place, trading in a pretty narrow range for both equities and bonds. As a result of that, hedge funds have done well. You've seen leadership from equity hedge funds, and overall, you've seen a gain, small gain for the overall HFRX index as volatility has fallen. Whereas equities, again, we show this here, very narrow decline again thus far for the first 2 weeks of June.
I see. So, what is the leading area in June so far?
Yeah, we're seeing a continuation of some of the same trends that we saw in May. The leading area is the HFRX equity hedge, which you can see here has gained 0.75% in the first couple of weeks of June. That's followed by fixed income based strategies, the fixed income relative value index, which has gained about 0.33%. Overall, narrow gain for the index overall, just about 10 basis points. Event driven, which is also a directional strategy, has posted a narrow decline of about 0.25%, which is about the same as what we have for U.S. equities, which is a really pretty small net change when you consider how volatility has fallen thus far in June. And we don't say that with the expectation it's going to continue that way, especially with all of the geopolitical risk that is very present with regard to not only ongoing conflicts, but upcoming elections and elections that are ongoing in Europe. There's a lot up in the air, but thus far in the first couple of weeks of June, you haven't really seen a huge change. And as we saw in May, when volatility falls sharply, as it has in the first 2 weeks of June, the uncorrelated macro strategies have posted a small decline of about 1% thus far in the first 2 weeks of June.
So, then I gather no major movements at the sub strategy level so far in June?
We've seen sort of a continuation of really a lot of the same trends from May. The leading area from the sub-strategy performance is the HFRX Equity Hedge Fundamental Growth Index, which is generally, which is not that surprising because generally in fundamental growth, you're going to have some emerging markets exposure, you're going to have exposure to technology and small cap and things like that. So that's the leading area, 1.5%, about 0.7% for the equity hedge, equity market neutral, which also an area that can do well because it's very mean reverting in terms of what drives the performance of equity hedge. When you see periods where volatility falls, a lot of dispersion can kind of revert to its historical norm. So we see a gain there, 87 basis points, a little better than 0.5% in convertible arbitrage, which is something that where it's long credit, long volatility, and generally short equities, but it's done well as interest rates have, even though they've only declined by a little bit, you see a little bit of credit tightening, and you see a gain there for the traditional convertible arbitrage strategies. Fundamental value, similar to fundamental growth, except generally in lower multiple positions, a gain of about 1/3% there. And then finally, relative value multi-strategy, which is generally fixed income based strategies, capital structure arbitrage, and things like that, that can converge and kind of revert to their historical levels when you see volatility decline like you have thus far for the first 2 weeks of June. And like we always say, we don't expect volatility to decline forever, but it can for short periods of time. And that's relative to a narrow decline, really kind of an unchanged mark thus far for equities in the first couple of weeks of the month.
So, would it be fair to say we're seeing that reflected in the year to date performance as well?
Yeah, I think what we saw at the end of May was that equity hedge and we can go back to that. Equity hedge and macro were really about the same place. I believe macro was a little bit ahead of equity hedge. And now with the small decline in macro and continued gain in equity hedge, that the leadership has, for the year to date, has flipped between macro, which is still up a very respectable 4.3%, to equity hedge, which is actually leading area, up 465 thus far for the year. And you can see that the overall composite of all strategies just narrowly pulled ahead of U.S. equities. Here we have 265, 254 there through the middle of June, thus on a year-to-date basis. And then, as you see here, the fixed income-based relative value arbitrage strategy we talked about earlier, up 1.15%, and then just about 1% for the HFRX event-driven, which, as you know, is also a directional strategy like equity hedge. That one was a little bit slower in the first couple months of the year, but has picked up since then. And we continue to see expectations for strong performance in M&A related special situations, merger arbitrage, activist distress, things like that. Those are all performing well.
At the sub-strategy level, are there any surprises so far in the year?
Yeah, we've really seen a continuation. Really, the two leading areas when we did the performance for May, fundamental growth again, directional equities, long biased, growth oriented stocks and technology and emerging markets and other growth areas. That has moved to the leading area performance at 7.4%. At the end of last month, it was the HFRX macro systematic diversified CTAs. Those are still having a very strong year, up 662, but with the volatility having declined a little bit, those gave a little bit of performance back from earlier in the year, but you still have the same two leading engines of performance. We talked about market neutral also. That's really the third area, up 3.7%, a little better than 3.25% for fundamental value. Again, all of those ahead of U.S. equities, and then we also have a decent year from the fixed income convertible arbitrage index. So across the board, we've seen good performance thus far for 2024.
That's a great performance snapshot for June. Thanks, Ken.
Great, thanks. And I just wanted to bring people's attention. We have relaunched the website just a short time ago, so please visit the new website, www.hfr.com. When you get there, please click on the investor guidebook. There's a lot of great information on our website about all of our index families. But if you click on the investor guidebook, it really talks a lot about the use cases that so many institutions are using for the HFR indices, really any of them, HFRI, HFR 500, HFRX. If you're watching this video, you know we do regular videos on YouTube. So please feel free to subscribe to the channel. And if there are any questions you have, things that you'd like us to cover in future calls, please feel free to let us know and we can go into greater detail. And then certainly if you want to send an email to indices@hfr.com, you can email me directly, Ken Hines, Aniqua, or you can email anyone at HFR to set up a call to discuss any area of our indices or data or research that you'd like to get more detail on. So thanks for joining us today, and we look forward to talking to you later on in the month.